If you spend any time watching investment content on YouTube, you'll notice that one term keeps coming up over and over again: ETFs. Everyone seems to be talking about them, recommending them, and building their entire investment strategy around them. But they don't always take the time to explain what an ETF is. So I just thought we'd take some time today just to kind of run through how they work and why they're so popular. Before we run through the details of an ETF, I thought we'd take a quick step back just to run through what a fund is. A fund is simply a pool of money, just a pot that pools resources to create a buying power that individuals alone cannot achieve. Funds are just an investment vehicle, so they can be used in many different strategies. Some buy properties or invest in gold or bonds, others buy shares in companies. Think about property, for example. You might have enough to buy one apartment, which you may have to mortgage, paying interest that'll eat into your returns. But as a fund, what if they have enough capital to buy the apartment outright, or the whole building, or the entire block? More capital means more leverage, better deals, and greater returns. Most ETFs apply this same concept to the stock market. You might be able to buy one share of Apple, but could you buy a share of every company in the S&P 500 or every company listed on the Nasdaq? An ETF pools the money of thousands of investors to give the fund the buying power to hold a portfolio of hundreds or even thousands of shares simultaneously. You get exposure to all of them through a single investment. Let's start at inception. A fund launches and announces it's raising $10 million to invest in technology stocks. To raise that money, it issues 1 million shares at $10 each. Investors buy those shares, and the fund is seeded with $10 million. The fund managers go out and purchase shares in companies like Microsoft, Amazon, and Google. A year goes by, those underlying companies performed well, and the value of everything the fund owns is now worth $11 million. The one share that you paid $10 for now has an underlying value of $11. Your investment grew because the companies inside the fund grew. Here is where ETFs get interesting. Those shares in the fund are themselves traded on the stock market just like any regular stock. If you believe the fund will keep growing, you might list your share for $12, pricing in future growth. If you're nervous about a downturn, you might sell for $10.50 just to exit safely. The price people are willing to pay and accept is what determines the market price of the ETF at any given moment. The market price is generally correlated to the actual value of what's inside the fund, but sentiment, confidence, and future expectations all play a role in where it trades day to day. Diversification is one of the most powerful benefits of the ETF. Instead of betting everything on one company succeeding, you can bet on an entire industry or market. Our technology ETF means that you're not gambling on whether Microsoft beats Google. You're investing on the belief that technology as an industry will grow. If one company stumbles, another may surge, and the overall fund absorbs the impact far better than a single stock would. ETFs can track an entire stock exchange, specific sector, country, or even a theme like clean energy or AI. The composition of what makes up the fund is defined upfront with allowances for adjustment over time. When the fund managers are buying and selling shares to rebalance and manage the risk of the portfolio, it doesn't trigger any tax event to you as the individual. Whereas if you were buying and selling individual stocks, you would have to consider the tax implications of any proceeds. Another reason ETFs have become one of the most popular tools for individuals saving for the future or retirement is that they can be purchased in fractional shares, meaning you don't need to invest or save up for a full share. You can invest exactly what you want, $50, $100, $200, whatever suits your budget, and own a proportional slice of the ETF. The set it and forget it approach is deeply reassuring. You invest a set amount regularly, the fund compounds over time, and you watch it grow without needing to actively manage individual stocks. Some of the most widely held ETFs include VTI, which would track the overall US stock market, VOO, which would track the S&P 500, SCHD, which focuses on dividend growth, and SCHG, which targets large cap growth companies. A common long-term strategy combines a core holding, a growth holding, and a dividend holding at percentages that reflect your age and timeline. A younger investor with decades ahead might allocate 40% to VTI, 40% to SCHG, and only 20% to SCHD. Someone closer to retirement might shift that and move more towards dividends for stability. Setting aside $500 a month and splitting it across these categories consistently over 20 or 30 years is one of the most straightforward paths to long-term wealth building available to everyday investors. The beauty is in the simplicity. You set it, you add to it consistently, and you let compounding do the work.